Hello and welcome. My name is Greg Klein with Hayes Financial Group. In this presentation, we will be discussing Social Security, how the Social Security system works in general, the status of the program, when you should take your benefits, a bit about spousal and survivor benefits, and then lastly, taxation of your Social Security. So let's get into it. First up, let's review some of the fundamentals of Social Security and how it works. Similar to how an employer-sponsored retirement plan works, you have to become eligible for Social Security. To do this, you do it by working and paying Social Security tax. As you pay taxes and earn income, you earn credits towards Social Security benefits. The number of credits you need to get retirement benefits through the Social Security system depends on when you were born. I'm assuming that most people listening to this were born in 1929 or later, so that means you need 40 credits or 10 years of work, and no benefits can be paid if you do not have enough credits. During your lifetime, you'll probably earn more than the minimum number of credits, but these extra credits don't increase your benefits. We'll see in just a moment how the actual benefit amount is calculated. Then individual contributions are made through payroll tax or FICA or the Federal Insurance Contributions Act. That's the withholding that you as an employee and the employer both pay. You pay half and the employer pays half. The total is 15.3%. So you pay 7.65%, of which 6.2% is for Social Security. The other 1.45% is for Medicare. And as I record this presentation in 2020, the Social Security tax that goes on the first $137,700 that you make in earnings. And then after that, the payroll contributions end. So there's Social Security tax on up to $137,700 of your income. Then benefits are based on your lifetime earnings, actually 35 years of earnings. So there's an average indexed monthly earnings, and it's based on the 35 years that you earned the most. And then the Social Security applies this formula to these earnings to get your average basic benefit, or they also call it your primary insurance amount. And I know you're dying to see how that's calculated, so I'll show you that on the next slide. But what this means is that if you're a person who works just 10 years and then you qualify after the 10 years, well, your payment is going to be less because they're looking at 35 years of earnings. So in this example, they'd have 10 years of earnings, 25 years of no earnings. So that's going to reduce the average benefit. And then the money that you pay in taxes, just a reminder, it's not held in a personal account for you, waiting for you to take those benefits. The taxes are used right now to pay benefits to current retirees. And then any unused money goes into the Social Security trust funds. So you qualify, and your spouse can also qualify even if your spouse has never worked, never paid in Social Security tax. Your spouse may be able to get benefits if he or she is at least 62 and you are at least 62 and receiving your retirement benefits. And we will look at this a little bit more in the fourth section of the presentation. But there are survivor benefits too. You know, your widow or widower can receive, they can start to receive reduced survivor benefits at age 60. So we'll see a little bit of that later on. This gets into the weeds a little bit, but it's an example of how the benefit is calculated. In this example, you see someone with average monthly earnings of $5,800. So over there, top 35 years of earnings, they averaged 5,800. Then the monthly insurance amount, or the benefit that they get from Social Security, they get 90% of the first $926 that they made on average for their monthly earnings. Then 32% of the earnings between 926 up to about 5,500 bucks. And then less, only 15% on the average monthly earnings over the 5,583. There are cost of living adjustments that are made to this. So if this person gets a benefit of around 2,300 bucks, well, then there are annual cost of living adjustments. For 2021, the adjustment was just recently announced as I record this presentation, and they announced a 1.3% increase. So it's pretty small, about 20 bucks a month for the average individual or a married couple, receiving benefits. It's about 33 bucks on average extra each month for 2021. All right, so what is the status of Social Security? There's a lot of talk about the system running out of money. And actually, according to the Social Security Administration itself, they have a couple of different piggy banks or a couple of different trust funds that they're working with. There's the Old Age and Survivors Trust Fund that pays out retirement and survivor benefits. And then you have a Disability Trust Fund that's paying out disability benefits. And those are set to be exhausted around 2033, 2034, 2035, somewhere in that range. And I'll talk in just a moment about how exhausted is a relative term, because remember, that's the piggy bank. Some benefits can still be paid even if there's no money in that piggy bank, because as long as people are working, paying Social Security tax, remember, then those taxes can be used to pay out current beneficiaries. But it is important to remember that Social Security was never set up to be your sole source of retirement income. So no matter what role Social Security plays in your retirement plan, Social Security was never meant to be the only thing. But let's take a look at the program in a little bit more detail. Social Security is, as I mentioned, what they call an intergenerational transfer system. So that means today's workers are paying for current retirees and then other beneficiaries of the system. So they're collecting current taxes to pay out today's retirees. And my grandma used to always tell me, she used to joke and say, hey, kiddo, keep working because you're paying my Social Security. And she was right, because there's no account set aside for me with my name on it that my contributions go into. My Social Security tax goes to pay out current retirees. There's about 177 million as of last year, 2019, that pay into Social Security, something more than 64 million beneficiaries. So not a huge ratio there of the number of people paying in to the number of beneficiaries. When the program was first set up decades ago, there were a lot more people working than the number of retirees. That leads us to a situation where the taxes and interest on the funds that they have in the trust accounts or the piggy banks, that's not keeping up with the benefits that they're paying out. And so then they have to draw down these trust funds, and where it's projected to be depleted around 2035. But remember, that doesn't mean Social Security is going to be bankrupt. In fact, if the trust funds are emptied, Social Security can still pay about 79% of current benefits, so around 79 cents on the dollar. So that means even if you're relying on Social Security in your plan, an average person, as you can see on the slide on the right, before the trust funds are depleted, might be getting something like 40%, 35, 40% of their pre-retirement income in retirement from Social Security. So around a third, maybe 40% of their income in retirement is coming from Social Security. Now, after the trust funds are depleted, you can see on that slide, it will go down. So that means you might get less, but it's not that you'll get nothing. So, and you see those benefits are projected to be able to be paid out for many, many years. So even if there's no money in the trust fund, they can still pay out something like 3/4 of the benefits. That means if you're counting this in your retirement plan, sure, you might want to assume that it's going to be less than the rosy projections that you get from Social Security, but I don't think you have to go as far as assuming that nothing will be there for you. This chart will show some averages, so percentages of different ranges of pre-retirement income, and then how those individuals in those different income ranges, how their income goes down in retirement. So you see most retirees live on less than what they lived on when they were working. Most will be in that 75 to 80% range. Now, it will also show what Social Security is projected to replace of that pre-retirement income. And then the difference is how much individuals would have to come up with out of private sources like 401ks, 403bs, 457s, IRAs, so your employer-sponsored plans, individual retirement accounts, personal savings. That would be coming out of that blue section on this chart. So you could not include Social Security in your plan, but that would be sort of a worst case scenario. But then you'd have to be prepared to make up for that purple section on this chart. So yours would just be blue. You would have to make up much more out of personal savings. So like I said, I think it'll be there for you. If you want to assume that these projections from Social Security that you might be getting something 35, 40, 50% of your pre-retirement income from Social Security, you might want to estimate those being less, but I think you can still safely assume there's going to be something there for you. But the sensible thing to do, is to save more. You have control over that, so save more. Use your retirement plan at work to save more, because like I said earlier on, Social Security was never meant to make up everything. You're supposed to have some of your personal savings, and your retirement plan at work is going to be the easiest, cheapest, best way for you to build those savings. One of the crucial questions is, when should I start taking my benefits? And we'll look at that next. So let's look at full retirement age. That's when you're eligible for your full benefit. This will influence your decision about when you take benefits. It starts at 66 for anyone born between 1943 and 54. Then it gradually increases up to 67 for those born in 1960 or later. Anyone turning 62 this year, your full retirement age is going to be 66 years and 8 months. And so there, it gives you an idea of when you qualify for full benefits, which will influence your decision. It's interesting to see when most retirees do elect to receive their Social Security benefits, and you can see many elect early at age 62. You can take them as early as 62 all the way to age 70, but remember that when you start receiving benefits early, you're going to get a reduction, and obviously that's a personal choice, and you want to make an informed decision. If you can't wait, if your current cash needs require you to take it early when you retire, or your health and family longevity is not so good, whether you plan to work in retirement, that's going to influence things that we'll take a look at. It's a very personal decision, but I think you can see on this chart that a lot of people have that regret aversion, meaning that they want to take it as soon as they can because they think, well, what if I don't live a long time? Then I'm not going to get anything out of all the Social Security that I paid. So they look at taking it early, where we will see that many people live long lives in retirement today, thanks to modern medicine. So that's something to seriously consider when you're looking at taking your benefits. The reduced benefit if you claim Social Security before your full retirement age is, and what you can see on this slide, you'll have full retirement age of 66 on the left, 67 on the right, and you can see the discount or the reduction if you take it at 62 could be as much as 30%, between 25 and 30%. For most people now, it's going to be closer to that 30%. Then full benefit would be at around age 67 for most people today. And then enhanced benefits would be suspending and waiting, not taking at your full retirement age, but taking later at 68, 69, 70. 70 is the max. After 70, then there are no increases in the benefits, but it is an 8% raise for each year that you wait up until age 70. And so that is not only for you, but that would also be for your survivor. This is a decision that you want to make as a couple if you're looking at you and your spouse, especially if your spouse earned a lot less or did not work during your lifetimes together. It very well could pay to delay. It's a personal decision. You want to do it based on your circumstances, you and your spouse if you're married. There's no correct age for everybody. The rule of thumb is that if you can afford to wait, then delaying can pay off for you over the long term. One of the biggest mistakes that retirees make is deciding to take their benefits too soon. Of course, if you have poor health and you just can't wait, you get to 62, you can't work any longer, you need the cash. I mean, there's nothing you can do at that point. But delaying can pay off. You can suspend the benefits all the way to age 70. You can see on this slide for a nice round number of $1,000 benefit at full retirement age, how much that goes up, almost $300 a month, and that makes a big difference in your retirement lifestyle. Almost $1,300 versus $1,000, and that's a guaranteed 8% annual increase. There aren't many investments that are going to guarantee you 8%. So if you delay another year, you can guarantee yourself another 8%, and that lasts for the remainder of your life. So that's a serious advantage if you can delay. You can get Social Security and work at the same time, but if you're younger than your full retirement age and you earn more than a certain amount, then your monthly benefits would be reduced. And so you can see that on this slide, the amount that they're reduced, it's not totally lost. So I say reduced because your benefit will be reduced until you reach your full retirement age, and then things are adjusted and you would get those benefits back. But if you're working and you take Social Security early, ahead of your full retirement age, your benefits will be reduced based on how old you are and how much you make. So you see if you're under full retirement age and you're making more than $18,240, then it's a $1 reduction for every $2 that you earn above that limit. Now, if you are in the year that you reach full retirement age, so you're working, but you're going to reach full retirement age this year, then they're reduced a little bit less, $1 for every 3 that you earn above 48,600. And then starting the month that you reach full retirement age, there's no limit. So that's another advantage of waiting to get your benefits until your full retirement age, because then you can get your Social Security and work if you choose to do so, and your benefits won't be reduced. You can earn as much as you like and they won't reduce your benefits at that time. Living to your late 70s or older, waiting to collect your Social Security can be rewarding. The break even is difficult to calculate because you're making some assumptions, and you don't know if you take Social Security early and maybe you don't need the money and you invest it and you make a fortune on that investment. Well, yeah, then it might pay to take that Social Security early. So we have to make some assumptions, and we have to assume that your life expectancy as well. So while it's not perfect, you can make some assumptions and look at, an average rate of return, average life expectancy, and you see if you live to 76, then you actually come out ahead if you wait to take benefits at your full retirement age versus 62. If you live to 79, then you'd be coming out ahead if you waited and suspended and took your benefits at age 70 versus taking them early at 62. And if you live into your early 80s, around 82, you benefit by suspending and taking the benefits at age 70 versus your full retirement age, which on this slide, in this example, it's 66 for this person. But Social Security, it is more insurance than an investment, so you want to think about it that way. You want to look and analyze your situation. Social Security is there to provide for you as a safety net. So if you do live a long life, and that you have something there for you. So think about it a little bit more as insurance than a straight investment when you're looking at that break even. Very important to consider is how long your retirement will last. What is your life expectancy? Again, individual, you know better than I do, but if we look at some averages, we can see that there's a 50% chance that males are going to make it to 86, females 88, so that's assuming that you make it to retirement at age 65. Then the chance that you're going to spend 20 plus years in retirement are pretty good. And if you both retire together at 65, at least one spouse has a 50-50 chance to make it to the early 90s. So we just saw early on that break even that if you're living to your late 70s, early 80s, it pays to delay, and most people are living to that point now. With modern medicine, you can see even upwards of 75% of retirees live that long. So that's why it can pay to delay your benefits. Take that into consideration when you choose when to start receiving Social Security. Spousal benefits, a spouse who has not worked or had lower earnings than their significant other is entitled to as much as half of the retiree benefit for the worker or the higher earning spouse. So we want to get into that in our next segment. Spousal benefits, they're important in deciding when to receive because, if you're married, this is a team decision, so it's important to understand how they work. Even if your spouse has never worked and never paid into Social Security, they're eligible for up to half. And you can see that on this slide. It shows again just a nice round $1,000 benefit. They should get half of that, or $500, but how much it can be reduced if they take that spousal benefit early. So the spousal benefit, like I said, it can be as much as half, depending on when the spouse, or I'll say like the lower earning spouse, when that individual starts to receive benefits. And it probably works best to bring up an example. So I put an example on the slide because the spousal benefits, they're always based on I'll say the worker's benefit or the higher earning spouse's benefit at full retirement age. In this example, you can see the higher earner's benefit at full retirement age is $2,400. So the spouse can get up to half of that, or $1,200. The higher earner in this case decides to take benefits early at age 62, gets a reduced amount, gets only $1,800. So you might think then that the spouse is only eligible for half of that, or $900, and that would be incorrect. The spouse is eligible for half of the higher earner's benefit at full retirement age, as long as the spouse waits. So in this case, you see on that third bullet point, the spouse waits till his or her full retirement age and then gets that full spousal benefit that was coming their way. They get half of the full retirement benefit for the higher earning spouse. And this is a little bit different. These spousal benefits do not increase beyond full retirement age. So where the individual worker benefit can keep going up if you suspend it to age 70, that's not the case for spousal benefits. They don't go up past full retirement age. And so that's something to consider if you have a spouse that earned significantly less or did not work, on how those spousal benefits work with Social Security. Survivor benefits, so looking at the spouse receiving the benefit as we saw in the previous slide, or the spouse receiving a benefit if their significant other passes away. And so you want to consider this because even if you're in poor health, beginning your benefits early, that can leave your surviving spouse a much lower benefit for the rest of his or her life. You want to consider your joint life expectancy when making this decision. A lot of couples, they want to start collecting their Social Security right away at the same time, but it may be best for the higher earning spouse to delay, or if one spouse did not work, the spouse that was the worker delay receiving Social Security. There's no magic bullet, but the reason why it often pays to delay is because survivor benefits are going to be based on the worker, I'll say the higher earning spouse's benefit. So where we saw previously, spousal benefits are based on the higher earner's benefit at full retirement age, and then they look at when does the spouse take it. Now, survivor benefits are going to be based on what was the benefit that the higher earner was receiving. So if the higher earner suspends and waits until age 70 to get a higher benefit, then that means that their survivor will also get a higher benefit. That's why you want to consider this when thinking about survivor and spousal benefits in with your Social Security. Benefits also apply to ex-spouses, so just in case you were married for 10 years or longer and divorced, you can be eligible for benefits on your ex-spouse's record. As long as you're unmarried, you still have to be at least 62 or older. Your ex-spouse does not know that you're applying for or getting those benefits, so that's nothing to worry about. But just so you understand that too, in case you're in a situation where you were not working and then divorced, you'd still be eligible for benefits. Last up, we'll look at how benefits are taxed. To determine how much of your Social Security benefits are added to your income, the IRS uses this thing called combined income. And you'll see the formula there, how they come up with combined income. It's half of your Social Security benefits, adjusted gross income, and any non-taxable interest. So when we're seeing how much would be taxed, we're looking at combined income. And we'll see more of that on the next slide. And this is regardless of your age. Once you start taking Social Security, your benefits may be taxable. If you're single and your income exceeds $25,000, or if you're married, filing jointly, $32,000, and then even more can be taxed up to 85% if you're single earning more than $34,000 or a couple earning more than $44,000. You're not required to have Social Security withhold federal taxes. You can if you choose to. So you can't have federal taxes like you used to with your paycheck. You can have federal taxes withheld also from your Social Security check. And then 13 states actually tax Social Security benefits as well. And so this is regardless of your age. If you're getting enough with benefits and other parts of that combined income, then you might pay taxes on part of your Social Security as well. This presentation just scratches the surface. It's a high-level overview of Social Security. If you want to do some more research on your own, the Social Security website is nice, easy to navigate. I mean, it is designed for retired individuals, so it's not super complicated. It's pretty straightforward, easy to navigate. You can go into your individual account. Like for instance, myself, I don't get a paper statement anymore. I got to go online to see my Social Security statement every year. You can also do an estimator. So if you just want to estimate quick, what am I looking for if I keep earning the same amount for the rest of my career? What's my benefit looking like? You can use that estimator, but just all the benefits that are available at the Social Security, the retirement portion of the Social Security website, I highly suggest if you want to do some more research to check that out on your own time. What it boils down to for you is, do you want to assume full benefits in your plan? Or are you thinking of reducing the amount that Social Security will provide for you in retirement? I believe that you can count on some Social Security. As we saw, as long as people are paying into the system, you'll be able to assume some amount of benefits, but you might want to assume less than the rosy benefit projections that Social Security is providing to you today. And then the other thing that you want to consider is whether you wait or not to get your benefits. And I think that you should consider taking benefits early if you can't work and need to retire and you just need money to make ends meet. If you're in poor health and you're single, then why wait? Or if you and your spouse are both in poor health, you might need to take your benefits early. Or if you are the lower earning spouse and your higher earning spouse can wait, well then as the lower earning spouse, you can take your benefits early. Consider waiting if you're still working. Why take benefits if you're still working and get a reduced amount? If you're in good health, you might want to consider waiting because remember, it doesn't take much living to your late 70s, early 80s for it to pay off. And then if you're the higher earning spouse and concerned about leaving your spouse the biggest survivor benefit possible if you were to pass away, then as the higher earning spouse, you would want to consider delaying your payment to give your survivor the biggest benefit possible. We are always here to help you. My name again is Greg Klein with Hayes Financial Group. My phone number, email address is on this slide. Our website, hayesfinancialgroup.com/resources, has a few presentations there, so check out those resources, and we look to talk to you in future webinars. Take care of yourself, and we'll speak down the road.